Hey, what's up, guys? It's been about a few weeks since I made a video. I just been, super busy with everything else that's been going on. So this video is kind of give you guys like an update, and we're going to talk about the market turbulence right now, coronavirus, and what that means for real estate investing, and quite possibly stocks too, right? So just a quick update for me. I just did a cash out refi. I'll be posting up another video of an investment I'm looking at, and we'll do like a deal breakdown. Or actually, I already did it, so I'll post it so I kind of see or show you guys like how I evaluate properties or deals. I'm not saying my way's right, but that's the way I view it. Maybe someone could drop in a tip or give different suggestions about how they might view a deal or that same deal, so we can learn from it, right? So lately, I've been asked a lot, like all my friends and some family members that we talk business and stuff, and they're like, "Man, what do you think about the coronavirus and stuff, man? Like, what's going on and this and that?" And the best analogy I could give is kind of like, let's say you were dating somebody in a relationship, right? Male, female, whatever. You're dating someone, and you say, outside of somebody like physically beating you up or like doing something crazy or having, like off the wall stuff with the relationship, but we don't like, cheating or whatever. But if it's just a natural breakup, usually you'll get in a fight or an event will happen or whatever, and you'll say, you know what, this is the tipping point, right? And then you'll tell the other person, hey, we just got to go our separate ways or whatever. And what I'm viewing the coronavirus as right now is that for the economy. It's like we were dating this ride, this hot thing that was just going all the way up, and there still is a lot of turbulence in the back, that are underlining problems in the economy and or global economy, and the coronavirus is just kind of like the straw that broke the camel's back in a sense, right? So that's what I think it is. I don't think it's something that's going to cause like that is the reason why. I think because of that, it's given a lot of people pause, and it's getting a lot of people to reevaluate their positions, and most importantly, it's caused huge supply chain disruptions. So, if you're not familiar with the terminology of supply chain, it's literally like you could literally think of like a chain, like a chain and stuff, and how one thing gets from one end to the other, and it has to touch multiple hands. Let's take Apple for example. I'll talk about two companies. One was Apple and one was a toy maker I saw the video on. So with Apple, it was Tim Cook came out and he said, how do you, because Apple's been ripping up, and I think last time I checked it was like 280 now, and it was not, that was from when it went up to like 300 at its highs, 300 plus, and it's dropped down. I think it got low as like 260, 270, I think, and it's 280 now. But essentially the fundamentals on that company is strong. But from where they get their components, from China, South Korea, then shipped here or assembled there. When you make an iPhone, it's not just, oh, it's right from China. It's a huge misconception. The iPhone is a global, product. Everyone has a hand in making that iPhone. Like there's companies that make little parts and components for it. It's assembled here. It's designed in California. So everyone has a little bit of it in it. And they said, because of the coronavirus and China being shut down, there's some parts that can't move to the other. Those parts can't. Then that phone can't be completed. Products in general can't be complete, and they can't be shipped here and sold here. Not just here, but just everywhere and in general, right? So that is the supply chain. Is like it starts here, then it goes here, then it goes here, then it goes here, and the faster it is, and there's more deep. There's lean. There's all kinds, like the Six Sigma and stuff. But basically the basic principle is it's a way a product starts to way a product finishes till it sells. So Tim Cook's thing is like, well, the reporter asked him like, hey, are you gonna maybe bring more factories back to the U.S. or whatever? And he gave a really smart answer. He's like, open to options, whatever. But he said, basically, this is a perfect time for us to test our relationship and the strengths of our supply chain. When we do face a crisis like this, then we'll be able to see if we could, how we're going to rebound from this, right? And that's a really good point, because at the end of the day, man, life happens, right? It's not just this coronavirus. I mean, we've had, U.S. gets hit with hurricanes all the time, Sandy and like Harvey and Katrina, and just It devastates areas, it devastates regions. It just doesn't have a huge ripple effect right now because this is a little bit different because I could be a global pandemic, or the media is hyping it up to be, you know. I'll leave the medical stuff to whatever, but we'll stick to the business part of it, you know. But yeah, like basically stuff's going to happen, right? Governments are going to change. We live in a global economy now, and if you're thinking about business, even real estate, you got to think globally, right? Like there are things that could help you in real estate globally when you think that way. Like you could get stuff made in China cheaper than you can here. Like, you know, if you're doing a big unit project like tiles or toilets, or, you know, but just, you know, that's where we are in the world right now. You know, it's no longer a domestic thing. So what he said is like, it's not necessarily that we're going to move, it's we're going to test the strength and the resilience of the supply chain and be able to get up and coming. And why is all this important? Why is that affecting stock markets? Well, in my earlier videos, and like I encourage everybody to go ahead and watch other videos, get the knowledge. The stock market is it's a futures market, right? The price you're paying today for a stock is what you think the company's going to be worth in the future. And like me, I'm a value investor. I said it's a cheap way, or like a cool way of saying you just like stuff that's cheap. You know, like the stock to be cheap. So essentially, you don't want to pay the price of the stock that it's maybe worth tomorrow. You want to pay the price that it's worth today. So, you know, just a quick refresher. If you're, you know, this thing is $1 and you sell one of these a year, and it's, you know, in 10 years, you'll have 10 of these sold. So you've made, you know, $10 in sales, let's say $5 in profit at 50%. So do you have to discount that at a rate back? And that discount rate would be, you know, whatever the safest asset at, which is, you know, government bonds and stuff. So you discount that amount of money back here, and then you'd want to pretty much pay less than $5 today. You wouldn't say, I'm going to pay $7 for that share because I think in year 7 or 8, it's going to boom. You know, you got to keep reliability. We're getting off topic, but basically because of that supply chain disruption, now people are like, oh my God, like is Apple, and that's not just Apple, everybody, right? They're like, oh my God, are they going to be able to get these products out there? If they don't, then what's the outlook like? That means they're going to have less sales. That means the stock's worth less. And that's why they're having a huge pullback. So think about that pandemonium wildly. For example, there was a toy maker out of Cincinnati, or not Cincinnati, I'm sorry. It was Ohio. It was out of Ohio. I forgot the exact name of the company though, but it's not publicly traded. And they got him on Yahoo Finance. I was watching it, and he pretty much had the same thing. He's like, this disruption right now, it set us back for Christmas time of this year of 2020. So if you think for a toy maker, those stocks have been just smashed, man, you know. And it's like, think about that. Their biggest holiday season, their biggest holiday time has been, you know, in December and November, gearing up for Christmas, right? Like Black Friday, you know, whatever. And now that's been delayed. They're not going to have the toys there, or they aren't going to have the toys there to be able to sell it. So of course that's going to impact the stock now and in future growth. And so you could see how this could be a problem. So it's not necessarily everyone's going to die, but it's the disruption. So my opinion on it is, no one wants to catch a falling knife, right? So a falling knife thing is like, you know, when it's like, this is a stock and you throw it up and it's ripping up and it's going up forever, you're like, yeah, woo, you know. But then when things go bad, it's coming down really sharply. And right now I feel like everything's coming down really sharply, and maybe some of it is an overstatement. There are really good buying opportunities there, but you got to be careful. I mean, I'd rather miss out on a 5-10% jump and jump in when I think things are smooth and gain an extra 3 or 4 or 5% and be in a good, steady, fundamentally sound company and not speculating, and be able to protect my capital that we all work so hard to get. It's not about making $1 million. The stock market game, just like in real estate and everything, is never about making a lot of money out of the way. It's mostly protecting the money that we put in, right? So I would just kind of let things play out. Let's look at the forecast. Let's look at the next quarter. As March is coming up, April, you're going to see a lot of companies reporting and forecasting, and you'll kind of get a clearer picture. But one thing I did want to touch upon is also market. So every single day, like when I wake up, you know, one eye just like looking at the phone, like what's going on, responding to text. First thing I do is open up the Yahoo Finance app, and then I go straight to the market section, and I go straight to 10-year treasuries. Why? Because 10-year treasuries are directly linked to 30-year fixed mortgages. And for the first time ever, we have had, or not first time ever, or I said in 50 years. In 50 years, the first time in 50 years, that they've came down below 1%. And I started looking up interest rates, and now we're creeping in the low threes, and possibly could go below 3%. A good source to touch up, because my knowledge on this is I'm still trying to grow, right? I'm not an expert in any way, so I would recommend to you guys to get more details on, other than the basics, coupons and whatever for bonds, but like what's going on in that market, how it could affect it, is you got to check out Real Vision on YouTube, and they do a really good job. They have a lot of stuff, and they talk about stuff like on a global scale. It's a great resource, and they do a great job. But basically, I just wanted to give that shout out to them because they make great content. But basically, like, the rest of the world has been, they've tested, getting shaky here, they've tested negative bonds. So like Japan and stuff. So you're like, negative bonds. It's like, yeah, I mean, essentially the government would be paying for investors, or the investors are paying for you to take their money, in a sense. And I don't understand it. I can't make sense of it. And the scary part, for us in California, and I guess in general, is like a lot of retirement accounts and pension funds do rely on these bonds and these yields to be able to pay out their payees. And CalPERS was one of the biggest in California, and they got really, I guess, pension funds in general have been really lucky since President Trump has taken over, because literally the stock market has had doubled. It's a little bit below double now, but that has saved them. And pension funds are relying on, like, I think in California, it's 7% is what the yield needs to be. They have to be able to generate a 7% return a year in order to fund these pensions. And like I said, they've been very lucky for equities being able to come up. And I think that's also driven up the prices of equities. You got all these people just continuing to pour cash in. They're not looking at what the asset's worth. They're just like, screw it, it's going to be more, we'll cash out later. And, it's just like flipping this money thing. But now some of you might be saying 7%, bro, that's nothing, bro. Like, we could make that on like an easy flip or an easy deal or whatever. Yeah, but like the capital we're working with, like, even 100 million, 7% averaging, not that bad. A couple million, 7%, super easy. You should be able to do it very, very easily, because you have that cash buying power. Now, if you're working with something in the billions, what are you going to be able to buy, and how quickly it's that asset allocation, that capital allocation, to assets, that it's a burden in a sense. It's a good problem to have. You have a shitload of money, but it's great if you're an investor. Have someone have a gun to your head and say, you need to put this money to work. It's better to be like in a Warren Buffett position, where you're sitting on the money like, you know what, coronavirus, it might be a good opportunity here. Let's let things shake down, because you don't have pension funds and teachers and firefighters and cops and everyone else yelling down your throat saying we need our money, and you don't have state legislation that says what the hell is going on, why isn't this money here? So it creates all this pressure. And human behavior has always impacted stocks, like and markets, all markets, real estate market, everything. Human behavior will never change, even as computers are running it. The way we are naturally is just, just in California. I mean, we're buying stuff at 3-4 cap, just continuing to think that things are going to go up. But if you just look at the asset, you're like, how can you pay $1 million for something that's only going to rent at $2,000 a month? But people are still doing it because they're thinking that someone else is going to come around later and pay $1.1 million and $1.2 million. And I agree to a certain extent. There's certain areas like in California, like San Francisco and LA and San Diego, that people don't care about the investment. They want to live in the lifestyle. But other areas, it's like, man, I don't know how much longer this charade of just going up is going to continue. So just to kind of wrap it up, I mean, the coronavirus, we'll see how it lasts out. I hope to God that no more breakouts happen and we live peacefully and continue on. But that's the world we live in. It's disrupted supply chains, and that's what set us back. And it's continuing to disrupt supply chains, so that's why you're seeing this solid weight. And the 10-year Treasury, just keep an extremely close eye on that, and let's see what the Feds do to see if we could continue. Because if we could get stuff cheaper, why not? More deals for us and easier for us to get in, right? But I'll be posting a video soon about a deal that I'm trying to do, and or attempted to do. We'll see if it goes through or not. And yeah, just sorry I've been busy, and I hope to continue at least a video a week if I can.